Silver was about to hit $63. For weeks, the signals had been building, a breakout from the high 50s, climbing steadily, traders positioning for a run past 60. Then, just short of the target, it stopped. Not because the fundamentals changed, because something else happened first. A deal that was supposed to reshape the entire market quietly failed to arrive on schedule. And now, silver sits in a strange kind of limbo, higher than it's been in years, but frozen just below a number everyone was watching. The question every serious investor is asking right now is not why silver rallied, it's why it stopped. And what happens next could decide the next 12 months of the precious metals market. Stay with this video, because by the end, you will understand exactly what's holding silver back and what's coming to break the standoff. Welcome back to Currency Arc Insight, where we track the economic signals that mainstream media won't slow down long enough to explain. If this kind of strategic analysis matters to you, hit subscribe so you don't miss the next warning before it becomes headline news. And drop a comment below telling us where in the world you're watching from. Silver was climbing, and the whole market was watching. For weeks, the price had been building momentum. It moved up from the high 50s, pushing higher day after day, until it reached a level few traders expected to see so soon. Analysts began calling it a breakout. Retail investors began paying closer attention, and silver kept climbing, inching closer to a price that had not been touched in years. That price was $63 an ounce. To understand why this number mattered so much, it helps to look at what was happening behind the scenes. Silver had already gained more than 60% over the past year. Gold, the metal that usually gets all the attention, had only gained about half that. This was unusual. Normally gold leads and silver follows, but this time, silver was outperforming gold by a wide margin, and traders were starting to ask why. Part of the answer had to do with a story unfolding far from any trading floor. Reports were circulating about a possible agreement between the United States and Iran, one that could lead to the reopening of the Strait of Hormuz. This narrow waterway plays a critical role in global trade and energy movement, and any disruption or resolution involving it tends to ripple through commodity markets almost immediately. A Qatari mediator confirmed that language for a potential deal had already been drafted. A senior U.S. official even suggested an announcement could come within days. Markets do not wait for confirmation. They move on expectation. And the expectation of a resolved conflict, paired with reduced inflation pressure and softer signals from the Federal Reserve, gave silver exactly the kind of momentum it needed. Buyers stepped in. Prices climbed from the high 50s toward the low 60s in a matter of days. For a brief moment, $63 looked not just possible, but close. Then, almost as quickly as it began, the momentum stalled. The expected announcement did not come. The timeline quietly passed without any formal agreement being reached. There was no dramatic reversal, no sudden crash. Instead, the rally simply lost its energy. Prices that had been climbing steadily began to level off, then slip back slightly, trimming some of the gains that had built up over the previous days. This is where the story becomes more interesting than a simple price chart. Because what happened next was not really about silver at all. It was about expectation meeting reality. The market had priced in an outcome that had not yet occurred. When that outcome failed to arrive on schedule, the price adjusted. Not because the underlying reasons for silver's strength had disappeared, but because one specific catalyst had not delivered. This distinction matters enormously for anyone trying to understand where silver goes next. A pullback caused by a failed deal is very different from a pullback caused by weakening fundamentals. In the first case, the door remains open. The deal could still happen. The momentum could resume. In the second case, the entire investment case would need to be reconsidered. For now, the evidence points toward the first scenario. The broader forces that push silver towards $63 have not gone away. Inflation expectations remain a factor. The Federal Reserve's next moves remain uncertain. And the geopolitical story involving Iran and the Strait of Hormuz remains unresolved, not dead. What this means is that silver is not stuck because something went wrong. It is stuck because something has not yet gone right. The market is holding its breath, waiting for a resolution that could come from several different directions at once. And that is precisely what makes this moment so important to understand. Because when a market pauses just short of a major level, waiting on a specific and identifiable trigger, that pause rarely lasts forever. Something eventually breaks the standoff. The only real question is which direction it breaks. To answer that question, it becomes necessary to look beyond the headlines and examine exactly what comes next on the calendar. Because in the coming days, several major economic reports are scheduled for release, and each one carries the potential to either reignite silver's climb toward $63 or push it back down toward where it started. That sequence of events is where the next part of this story begins. While silver waited near its stalled high, something else was quietly taking shape in the background. A calendar. Not an ordinary calendar, but a sequence of economic reports and meetings that, one after another, would carry the power to decide where silver moved next. Traders had already priced in one major event, the possible resolution of tension around the Strait of Hormuz. That event had not yet delivered a clear answer, but behind it stood a long line of scheduled data releases, each one capable of shifting sentiment in a matter of minutes. The first of these was an employment report, due within days. Employment data tends to shape how investors think about the broader economy, because a strong labor market can support a stronger currency, while a weak one often does the opposite. A weaker than expected report could weaken the dollar further and give silver room to climb. A stronger report could do the reverse, pulling attention back toward tighter policy expectations and slowing silver's momentum. Not far behind it sat a meeting tied to domestic mining policy, one that carried its own weight given growing conversations about metal shortages affecting sectors far beyond jewelry and investment demand, including defense and industrial production. Then came the reports that mattered most to nearly everyone watching the metals market, the inflation numbers. The Consumer Price Index, scheduled for the middle of the month, stood out as the single most anticipated release on the calendar. Inflation data has a direct relationship with how the Federal Reserve is expected to act. A hotter than expected reading tends to raise the odds of continued rate pressure, which historically weighs on precious metals. A cooler reading tends to do the opposite, often giving gold and silver room to move higher. Just one day later, a second inflation measure, the Producer Price Index, would offer another view of pricing pressure, this time from the perspective of businesses rather than consumers. Together, these two reports formed a kind of 1-2 combination capable of either reinforcing or contradicting the market's current expectations. The calendar did not stop there. Later in the month, additional reports covering import and export prices, along with industrial production figures, were set to provide a broader picture of economic activity. These numbers rarely dominate headlines the way inflation data does, but for those paying close attention, they offer important clues about the health of manufacturing and trade, both of which connect directly to industrial demand for silver. Shortly after, minutes from the most recent Federal Reserve meeting were scheduled for release. These minutes often reveal disagreements or hesitations among policymakers that were not fully visible in the original announcement. A single sentence buried inside those minutes has, in the past, been enough to move markets sharply in one direction or another. As the month came to a close, attention would shift toward a preferred measure of inflation used internally by the Federal Reserve, released alongside a fresh estimate of economic growth. This combination tends to serve as a final checkpoint before markets begin looking toward the next major Federal Reserve meeting, scheduled for the middle of the following month. Taken individually, none of these reports guarantee a dramatic move, but taken together, they form something more important, a sequence of pressure points, each one capable of nudging silver either back toward its recent high or further away from it. This is the part of the story most casual observers miss. They watch a single headline, react to a single number, and assume the story is finished. But professional decision makers understand that markets rarely move because of one report. They move because of an accumulation of evidence, building case by case, release by release, until a clear direction finally emerges. Silver, sitting just below $63, now finds itself suspended inside exactly that kind of accumulation. Every report on this calendar adds another piece to the puzzle. And piece by piece, the picture is beginning to form. But price action and data releases only tell part of the story. Beneath all of this short-term noise sits a much larger and slower moving force, one that has been building for years rather than weeks. Understanding that force is the only way to know whether this pause in silver's rally is temporary or something far more significant. Every headline about silver tells a story about a single day, but the real story has been building for 6 straight years. To understand why silver reacted the way it did near $63, it helps to step away from the daily news cycle and look at something far less exciting on the surface, the balance between how much silver the world produces and how much it actually consumes. For 6 consecutive years now, that balance has been broken. According to industry data, the shortfall this year alone stands at more than 46 million ounces. On its own, that number might not sound alarming. But this is not an isolated event. It is the 6th year in a row that demand has outpaced supply, and when those yearly shortfalls are added together, the total climbs to a staggering figure, more than 760 million ounces of silver that the world has consumed but never replaced. To put that in perspective, that shortfall is close to what the entire mining industry produces in a strong year. This is not a temporary imbalance caused by a single factory closing or a single mine running dry. It is a structural problem, one built into the very nature of how silver is produced. Unlike gold, which is typically mined for its own value, most of the world's silver comes as a byproduct of mining for other metals, particularly lead, zinc, and copper. This means that even when silver prices rise sharply, it does not automatically trigger a wave of new silver production, because the decision to open or expand a mine usually depends on the economics of copper or zinc, not silver itself. In other words, higher prices alone cannot fix this problem quickly. Meanwhile, demand for silver has been expanding from directions that did not exist at meaningful scale a decade ago. Solar panel production consumes enormous quantities of silver, and that number continues to grow each year as more countries invest in renewable energy infrastructure. Electric vehicles use significant amounts as well. And beyond the sectors that get the most attention, there are quieter sources of demand, including military and aerospace applications, areas that are often left out of standard industry reports entirely, meaning the true deficit may be even larger than official figures suggest. This growing demand, combined with a supply system that cannot easily expand, has created exactly the kind of imbalance that eventually forces a market to reprice. And that repricing appears to already be underway. Over the past year, silver has climbed more than 60%, while gold, the metal that usually commands more attention and more headlines, has gained only about half that amount. This is an unusual pattern. In most previous cycles, gold leads and silver follows at a distance. But this time, silver has been closing that distance rapidly, a shift reflected in what analysts call the gold to silver ratio, a measurement that tracks how many ounces of silver it takes to equal the value of 1 ounce of gold. That ratio has been falling steadily, a signal that silver is gaining strength relative to gold, not because of speculation, but because of a physical market where actual consumption is outrunning actual production. This is the part of the story that rarely makes it into daily headlines. Most coverage focuses on short-term price swings, geopolitical tensions, or central bank decisions, because those stories are easier to explain in a single sentence. But underneath all of that noise sits a much slower, much larger force, one that does not care about a single missed deadline for a diplomatic agreement or a single inflation report. That forces the deficit itself, and it does not reset when a news cycle changes. This is why the stall near $63 looks very different once this deeper context is understood. A price pause caused by short-term disappointment is temporary by nature, but a price trend caused by 6 years of consumption. Outpacing production is not something that resolves itself in a matter of days or weeks. It resolves itself over time through sustained upward pressure that persists even when short-term catalysts fail to deliver on schedule. And this raises an important question, one that becomes especially relevant once attention shifts away from the physical market and toward the institutions responsible for setting expectations around it. Because if the underlying deficit is this severe, one would expect the world's largest financial institutions to be in general agreement about where silver is headed next. As the next part of this story reveals, they are far from aligned. If the deficit is real, the world's biggest financial institutions should agree on what it means, but they do not. This is one of the most revealing parts of the entire silver story, and it rarely gets the attention it deserves. When a physical market shows 6 straight years of consumption outpacing production, one would expect the major banks and research firms tracking that market to converge on a similar outlook. Instead, their forecasts are scattered across an unusually wide range, and that gap says more about the current moment than any single price target could. At the more conservative end sits one of the largest banks in the world, holding a year-end target well below $65. This institution has consistently taken the most cautious view among its peers, revising its number upward earlier in the year but still remaining noticeably behind the rest of the field. Move slightly higher, and a different major bank places its target closer to the high 60s, citing ongoing supply tightness, but stopping short of forecasting a dramatic breakout. Higher still, another well-known financial institution sets its outlook near $75, a figure that would represent a substantial move from current levels and reflects a more aggressive read on how quickly the deficit could force prices upward. Then comes one of the most dramatic examples of institutional disagreement. One major bank initially projected silver would remain well below $40, a forecast that aged poorly as the metal moved sharply higher throughout the year. Rather than quietly adjusting by a few dollars, this institution revised its target upward by more than double, landing in the mid-80s, a shift so large it effectively admitted its original view had significantly underestimated the strength of the underlying trend. And at the very top of the range sits the most bullish major forecast on record, placing silver somewhere between $85 and $100, a number that would have sounded almost unreasonable a few years earlier, but is now being taken seriously by professional analysts. Line these forecasts up side by side and the picture becomes clear. The gap between the most cautious institution and the most bullish one spans nearly $40. That is not a minor rounding difference. That is the kind of disagreement that only appears when a market is going through a genuine repricing event, one where historical models and traditional assumptions no longer provide reliable guidance. This matters for a very specific reason. Financial institutions build their forecasts using models based on historical relationships, how silver has typically responded to interest rates, currency strength, industrial demand, and investment flows. When those models start producing wildly different outputs, it usually means the underlying relationships themselves are shifting in real time, and no single institution has yet built a model that fully captures the new reality. There's a deeper detail hiding inside this disagreement as well, one that goes against everything the textbooks say about how precious metals are supposed to behave. Under traditional market logic, gold and silver tend to perform best when real yields, meaning interest rates adjusted for inflation, are falling. Falling real yields typically push investors away from cash and government bonds and toward hard assets instead. But right now, real yields remain historically elevated. They are not falling. And yet, silver has still managed to rally sharply, gain ground against gold, and stall just short of a major psychological level. This is not supposed to happen under the conventional framework. When an asset performs strongly despite working against its usual macroeconomic conditions, it is often a signal that something more fundamental is taking over, something stronger than interest rate expectations or dollar strength. In this case, that something is the physical deficit itself, a slow-moving force that does not care whether real yields are rising or falling, because it is driven by consumption and production, not by monetary policy. This is precisely why the institutional forecasts are spread so far apart. Some analysts are still building their models around the old rules, where interest rates and currency movements dictate the outcome. Others appear to be recognizing that a different force has taken the wheel, one rooted in years of supply shortfall rather than short-term financial conditions. And when institutions this large cannot agree within a $50 range, it rarely means the market is confused. More often, it means the market is still in the early stages of figuring out what silver is actually worth in this new environment. An environment shaped less by headlines and more by a deficit that has been building quietly for 6 years. That question, what silver is truly worth once all of these forces are accounted for, is where the story now turns. Silver never actually broke down, it simply paused, and that difference changes everything. Throughout this story, one theme keeps repeating itself. A market pushes toward a major level, something interrupts the momentum, and observers rush to call it a failure. But a closer look reveals something very different happening beneath the surface. The pause near $63 was never a sign of weakness. It was a market catching its breath while waiting for confirmation from several directions at once. Now, with all 4 pieces of this story laid out, the full picture becomes clear. The first piece was the immediate catalyst, a diplomatic agreement involving the Strait of Hormuz that failed to materialize exactly when expected. This created the appearance of a stall, but, as shown earlier, a pause caused by a delayed announcement is fundamentally different from a pause caused by weakening fundamentals. The door remains open, not closed. The second piece was the calendar itself, a sequence of major economic reports stretching from employment data through inflation readings all the way to the next Federal Reserve decision. Each report carries the power to shift sentiment, but none of them exist in isolation. Together, they form a chain of evidence that professional decision makers watch closely, understanding that markets rarely move because of a single data point. The third piece, and arguably the most important, was the deficit itself. 6 consecutive years of consumption outpacing production do not resolve themselves in days or weeks. They represent a slow-moving force that persists regardless of what happens in any single news cycle. This deficit does not care about a delayed diplomatic deal or a single disappointing headline. It continues building in the background, applying steady upward pressure that eventually forces a market to adjust. And the fourth piece revealed something that many investors overlook entirely. A case where a major asset was performing strongly under conditions that traditional models say should not support that kind of strength. Real yields remain elevated, working against the usual playbook for precious metals, and yet silver continued climbing anyway. That single detail tells experienced observers that the old rules may no longer fully apply, and that a newer, more powerful force has begun shaping this market. When these 4 pieces are placed together, a clear conclusion begins to form. This is not a market driven primarily by headlines, interest rate speculation, or short-term political developments. Those factors matter, and they do shape day-to-day price swings. But underneath all of that noise sits something far more significant. A physical market where actual supply has failed to keep pace with actual demand for 6 years in a row. That kind of imbalance does not simply disappear because a single deal gets delayed or a single report comes in stronger than expected. This is precisely why the world's largest financial institutions remain so divided in their forecasts. Some are still relying on models built for a different era, one where interest rates and currency movements dictated almost everything. Others appear to be recognizing that those old relationships are breaking down, replaced by a structural deficit that behaves according to its own timeline. For those paying close attention, the message becomes clear. The stall near $63 is not the end of the story. It is a pause within a much larger transition, one that has been building for years and is unlikely to resolve itself quickly. What happens next depends on which trigger arrives first, whether that is a delayed diplomatic agreement finally coming together, an inflation report reshaping expectations around the Federal Reserve, or simply the slow and steady weight of a deficit that refuses to correct itself. But one thing remains certain regardless of which trigger arrives. The forces pushing silver toward $63 and potentially far beyond it have not disappeared. They have only paused, waiting for confirmation before making their next move. For serious investors and decision makers, the lesson here is not to react to every headline as though it changes the entire picture. It is to stay positioned, stay informed, and understand that the real story is often much larger and much slower than any single day's price movement suggests.